Namaste friends, this is sixth video lecture of learning journal entries in an easy way. Today I am giving a very important journal entries explanation. Usually very good number of students making mistakes in journalizing some critical entries. So I am explaining all the critical entries with reference to a PPT, and I named it as common errors in journalizing. And by the end of this video, we are going to learn what are the common mistakes done by the students, and at the same time how to correct and how to write actual journal entries in turn. So let us start screen sharing. Okay, common errors in journalizing. Already you know me, I'm Shyam Prasad, Faculty of Commerce in Tara Government College, and by the end of this lesson, we are going to learn about what are the cash transactions, what are the credit transactions, how to identify the cash transactions and credit transactions, what are the different goods accounts used in journalizing, sales account, purchase account, purchase returns account, sales returns accounts, and at the same time, common errors in journalizing. Okay, let us start the first one, that is identifying the cash transaction. Everybody knows cash transaction is nothing but the transaction which for which payment is already settled is called cash transaction. But you have to identify whether a transaction given in the problem is cash transaction or credit transaction. To identify this, to identify whether it is a cash transaction, credit transaction, first you have to see when a transaction is not having any personal account, that is deemed to be cash transaction. When a personal account is not given in a transaction, for example, TV purchased for rupees 12,000. There is no personal account, simply TV purchased, that is 12,000. That is obviously that is cash transaction. Some transactions may be having some personal account with cash payment. For example 2, you see mobile purchase from Ravi by paying 9,000. Ravi name is there and payment 9,000 is there. That means cash is settled. These are the two types of cash transactions which you come across in problems in journalizing. But how to write journal entries for this cash transaction? TV purchased for rupees 12,000. Already, who purchased the TV? Already you know very well. We purchased a TV for the purpose of business. So we purchased a TV 12,000 means. What are the two accounts involved here? One is TV account, another is cash account. So both are real accounts. Debit what coming in, credit what going out. TV is coming in, debited, and cash is going out, credited. TV account data to TV account data to cash account. So you see here, this is TV purchase for 12,000. TV account data to cash account being TV purchase. This is cash transaction. When no personal account is there, and at the same time, they mentioned TV purchase for 12,000 means when there is no cash, that is deemed to be cash transaction. So TV account data to cash account being TV purchased. Then mobile purchased from Ravi by paying 9,000. We bought a mobile from Ravi by paying him 9,000. That means also cash is settled. We already paid rupees 9,000. So we, as we paid, what is coming in? Mobile is coming in and cash is going out. So debit what comes in, credit what goes out. Okay. So mobile is coming in, debit mobile, and cash is going out. Credit the cash, credit the cash. So these are the cash transactions. And what are the credit transaction? The transaction for which payment is not yet settled, obviously, is a credit transaction. So usually in journal entries, if you want to identify the credit transaction, simply they give personal account. If a personal account is there in a transaction, that is deemed to be credit transaction. For example, you see here, purchased land from Rani 1 lakh. So here Rani mentioned means we didn't pay the amount to Rani. When we paid the amount, they have to mention amount, whether the amount is paid or not. So nothing is mentioned, so it is a credit transaction. So when we purchase when we purchase land from Rani, what are the two accounts involved? One is land account, you know very well, and the second is Rani account, you know very well. So land is a real account. So when we purchase, obviously it is coming in. When land is coming in, land account is debited. What about Rani? Rani is giver. Rani is giver. Giver account is credited. So land account to Rani account, being land bought on credit from Rani. This is credit transaction. A name is involved and nothing is mentioned about cash payment. That is obviously called credit transaction. Sale of furniture to Hari on credit 5,000. So furniture sold to Hari for rupees 5,000. There is a name is there and nothing is mentioned about cash, so it is a credit transaction. And they mentioned about credit also. So this credit transaction. So we sold furniture to Hari. We sold. So furniture is a real account. Coming in or going out, furniture going out. When furniture going out, furniture account is credited. And what about Hari, receiver or giver? When we are giving credit to him, automatically he is a receiver. Hari, the receiver account is debited according to personal account. So Hari account is debited and the furniture account is credited. Furniture account is credited. This is about credit transaction. So here Rani is giver. We purchase from Rani. Rani is giver. Rani account is credited. Here Hari is receiver. We given credit. We offered credit to him. Furniture, so Hari is receiver is debited. Land coming in debited and furniture going out is credited. This is about cash transaction and credit transaction. Then we have goods. You know very well, goods are the purpose of the organization. The purpose for which business exists is goods. Usually articles purchased by a trader with the object of resale. The objects articles purchased by a trader with the object of resale to earn profits are called goods. Goods are purpose of the business. The goods accounts are divided into four categories. Usually students doesn't give much priority to this very important aspect. One goods account is having four accounts in the journal entries. So when goods are bought, when goods are purchased, purchase account is debited. When goods are sold, sales account is credited. When goods are sold, sales account is created. When goods return to suppliers from whom we purchased, then purchase returns account is created. When goods are returned by customers to us, sales returns account is debited. So the moving of goods is of four types in organization in business. When we purchase, goods move in. When goods move in, goods are debited. Not goods account, but purchase account is debited. When goods are sold, goods are going out, moving out. Goods are going out, moving out. So goods account is created in the name of sales. When purchase returns, when we return goods to suppliers because they are not good, they may be some fault is there. So then the goods which are not in good condition are to be returned to the people from whom we purchased. So the purchaser from whom we purchased, suppliers are creditors. So when we are returning to suppliers, automatically they are moving out. When goods are moving out, purchase returns account is created. When goods because of defective goods returned by the customers who are called debtors. When customers returns goods, sales returns account is debited, sales account is debited. So the goods account is of four types. You have to see when goods purchased, goods are coming in. So purchase account is debited. When goods are sold by us, goods are going out. Goods are going out. So sales account is credited. When goods returned by us to suppliers because they are defective, so when goods are going out, purchase returns account is created. And when goods returned by customers to us because they are defective, then they are coming in. When goods are coming in, sales returns account is debited. So purchase account is debited, purchase returns account is created. Sales account is created, sales returns account is debited. So by this, the goods account is of four types in the business. So usually goods account doesn't say anywhere. Only you see when you purchase the goods, purchase account is debited. When you sell goods, sales account is created. When goods purchase return, purchase returns account is created. When goods sold returned by the customer, sales account is debited. These are of four types. So usually one mistake made by the students is they won't make a demarcation between purchase of assets and purchase of goods. When purchase of goods, when goods purchased only, purchase account is debited. When assets purchased, assets account is debited. We will discuss later. When goods sold, sales account is created. Sales account created means when goods sold, but usually students make a mistakes when asset is sold, furniture is sold also, they may create sales account. That is wrong. So these are two important. So I will give some example. 5 goods purchased from Rani, and goods purchased from Rani, this is also credit transaction. So, and when goods purchased by us, obviously purchase account is debited, or goods instead of goods account, purchase account is debited. When from whom we purchased, from Rani on credit, so Rani is giver, Rani account is created. So goods purchased, purchase account are to Rani account being goods purchased. Goods sold to Hari, goods sold to Hari. When goods sold, already when we sell goods, automatically sales account is created. Sales account is created. Sales account is created from. So we sold to Hari because it's a credit transaction. Hari is a receiver. Receiver account is debited. Hari account debtor to sales account being goods sold on credit. Goods returned to Rani. We purchased 12,000 goods from Rani. Yeah, out of them 100 rupees returned to Rani because they are defective. So goods are going, and goods are returned. Goods are going out. Goods account is created. But which return these are? We purchased and we are returning. Purchase returns account is always created. Purchase returns account is always created. When purchase account is debited, purchase returns account is created. When you are returning to goods to Rani means Rani is a receiver. Rani account is debited, being goods returned to Rani. Goods returned by Hari. We sold good to Hari on credit 9,000. In that 9,500 worth of goods are defective. He is returning to the goods coming in. So when goods coming in by way of return, sales returns account is debited, and the giver Hari is great. Is great. This is great. All are great. All are great transaction. All are great transaction. So, but remember, very very important. Usually students make mistakes. In purchases sales, when goods purchased only, purchase account is debited. When goods sold only, sales account is created. So purchase account, sales account exclusively used, purchase account, sales account exclusively used only for the purpose of purchase of goods, only purpose of sale of goods. So purchase account, sales account never to be used for the purpose of purchasing fixed assets. This you have to remember here. Remember here. Once again, I'm repeating. Purchase account is used when goods are purchased, not fixed assets. Sales account is created when goods are sold, not fixed assets. When fixed assets are sold, fixed account assets account is created. When fixed assets purchased, fixed assets account is debited. That is you have to remember in goods transaction. Next slide. Common errors. So the common errors you have to know. So what are the common errors? Already I introduced. When assets are purchased, asset account is debited. When assets are purchased, asset account is debited, not purchase account. This is very very important. When assets are sold, asset account is created, not sales account, not sales account. So usually when land purchased, usually people purchase account is there. So that they're wrong. I showed you also. When goods purchased, purchase account is debited. When goods sold, sales account is created. Sales account is created. These are the common errors. Common errors. The common errors. So you see, land purchase or land purchase. Usually, students purchase account whatever they purchase, they will purchase account. But this is wrong. This is 100%. This is wrong. So when land purchased, purchase account is not debited. Land account is debited. Land account is debited because from Rani is giver. Rani account is created. This is correct. This is a correct way of writing. Fixed when fixed assets purchased, land account is debited. Land account is debited. Land account is debited. This is wrong. This is wrong. Okay. This is right. This is right. So when land purchase account is not debited, this is wrong. Land account is debited, land account is debited. That you have to remember. This is the common mistake made by the students. When fixed asset purchased, fixed asset account is debited. When goods purchased only purchase account is exclusively used for goods only. For land, it is not used. This is wrong. This is wrong. So a land purchased, a land account to Rani because Rani is giver. So don't use purchase account for land, buildings, plant, machinery, furniture. Fixed assets. When come to furniture sold to Hari, when whatever is sold, usually students create sales account. No. Sales account is created whenever goods are sold. When goods are sold, when furniture is sold, furniture account is created. Furniture account. This is correct. The furniture account is created, and Hari is a receiver. Hari account is debited. So what is wrong? So when furniture sold, furniture account is created and not sales account. This is wrong. So what are the common mistakes made by the students? Purchase account is used for fixed assets also. Sales accounts also used for fixed asset. This is wrong. Using purchase account for fixed asset is wrong. Using a sales account for sale of fixed assets is wrong. So what is right? When fixed assets is purchased, that fixed asset account is debited. That is correct. When fixed asset is sold, that fixed asset account is created. That is correct. So using furniture account, using land account is correct. Using purchase account, using RE account is wrong. This is the common mistake made by the students. So once again, what is the common mistakes? Purchase account is used only for purchase of goods. Sales account is used only for sale of goods, not for the purpose of purchasing fixed assets. Sometimes if it is a furniture shop, in case of furniture shop, for example, Nilkamal Furniture Company, general interest we are writing. Nilkamal Furniture Company means furniture itself is a good. Then you can use when it is a purpose of business, when it is when furniture is purchased for resale, that furniture will become goods, not fixed. That is not fixed. That important point you have to. For example, in case of real estate company, what is the goods means? Land is good. Land is good. For real estate company, when land purchase account can be debited, but not fixed assets. That is very important item. Next, capital drawings account. You know very well these two are personal accounts of owner. When owner invests, a capital account is created. When owner withdraws anything from the business, drawings account is debited. You know very well. Capital account and drawings account are alias names of capital account and drawings accounts are alias names of owner. That's why capital account and drawing accounts both are known as personal accounts. You know, this is very important topic. So capital account is personal account, drawing account is personal account. So how to write capital account, drawing account? Most common mistake also made by the students is Rama started business with rupees 12,000. They cannot understand with their double entry rules also how money is coming in, how money is going out. They don't know. So when Rama started business, you know very well. So when you are using capital account, drawing account, you have to remember very important business concept, that is business entity concept. According to this concept, business and owner are separate and distinct from each other. Business is separate, Ram is. So when Rama started business with 12,000 means Rama giving 12,000 to business. Business means we are the accountants. So cash is coming in, 12,000 is coming in, cash account is debited. When Rama invested, Rama capital account is created. So cash account to capital account. This is correct. This is correct. Usually students make so many mistakes here, but you have to remember when Rama started business with 12,000. There is a distinction between owner and Ram and business. Business means we. Ram giving 12,000 to business means cash is coming in, and giver, that is Ram, is created. Giver means Ram. Who is giver? Here the giver name is capital account, Ram capital account. Some people will write Ram capital account also. That is also correct. That is also correct. Ram capital account is also correct. But students may commit so many mistakes here. This is wrong. This is right. This is wrong. So Ram started business means students will write so many mistakes here. Ram account data to Ram account to cash account to Ram. The correct entry is because cash is given by the Ram to the business. As there is separation between Ram and business, cash coming in, cash account is debited. The giver Ram is created, Ram capital account is created, Ram capital account is created. So this is about this. Next, Ram paid children's school fee from business 900. So Ram using 900 from the business for his children's school fee. There is separate. There is also separation between owner Ram and business. That means he is taking away 900 from the business. So cash is going out. So cash account is created. Cash account is created. So who is the receiver? Ram is the receiver. So Ram drawings account is written. Ram drawings account is debited. Usually some people write Ram drawings account debit to cash account. This is correct. But few students may write so many mistakes here. Fees account to Ram account to fees account to cash account. So many mistakes made by the students, but they are all wrong. These are all wrong. So the right is Ram drawing secondary to cash account. This is so. Yeah, here Ram using 900 from the business means Ram taking away. So cash is going out. The receiver is Ram drawings. Ram drawings account is debited. This is correct entry. This is wrong. Rama started business means Rama giving 12,000 to business, so cash coming in, cash account is debited, and the giver Ram capital account is created. So the capital account and drawings account are personal accounts. You have to remember by this example. This is very very important journal entry. So capital account, drawings accounts are personal accounts of owner. Owner represents two accounts. Whenever he gives anything to the business, his capital account is created. His capital account is created. This is correct. Whenever he takes away from the business, his drawings account is debited. This is very very important. And last slide, nominal accounts with personal accounts. Usually students also make mistakes with reference to expenses, usually debited, incomes usually created, very well. But they will be given sometimes with names of the persons to whom expense is paid, names of the persons from whom income is received. When expenses are paid, when incomes are received, the personal accounts are immaterial. Personal account need not be considered. This is wrong. Considering personal accounts with reference to payment, with reference to receipt is not at all correct. So salary paid to Rahim. Already we paid cash, so cash is going out and the salary is expenditure. Ram is immaterial, Rahim is immaterial. Yeah, Rahim is no need to. This is wrong. Right, debiting Rahim account is wrong. Rahim extended his services to the business, so so you will be given cash and salary because of salaries expenditure to the business, expenditure account is debited, cash account is created. But usually because of when personal account is given, students will use it at any way they will debit or credit or it may be. But whenever personal account are given with the nominal accounts, simply ignore them. Rahim account is to be ignored. When salary is paid to whom? So, for example, so there are 5,000 employees are there in an organization. We have to open 5,000 individual accounts or one salary account. It's okay when you open one salary account, we will pay salaries to all. No need to open all 5,000 personal account. Personal accounts are immaterial for expenses and incomes. Rent received from tenant Amar. So we received cash. We received cash from Amar, not from Amar. We received cash for the purpose of rent. So cash is coming in, cash account is debited. Rent is income, rent account is credited. Amar is immaterial. This is wrong. This is wrong. So Amar, that is whatever the cash received, that is Amar account is that. This is the wrong entry. This is the wrong entry. So rent received means cash account to rent account, but Amar account is not at all required here, and Rahim account is not at all required here. By this, you have to understand that whenever nominal accounts are given, the personal accounts are immaterial. Personal accounts are not. No need to consider. These are the very important. So I explained 12 journal entries. We'll make a recapitulation of one by one. So when a cash transaction is how to identify cash transaction? When there is no personal account, that deemed to be cash transaction. When there is a personal account with a mention of payment, that is also cash transaction. TV purchased means TV account to cash account. Mobile purchased means mobile account to cash account. How do you identify credit transaction? When there is a personal account is obviously if it is shown automatically, that is cash not settled, that is not out. Credit transaction, purchase of land from Rani, so land is coming in, Rani is given, Rani account is created. Sale of furniture to Hari, so Hari account is debited because Hari is a receiver and the furniture account. So here you have to remove another. So when land purchased, land account is debited. When furniture sold, furniture account is created. That you have to remember. Next side, that is goods account is of 4 types. So when goods account, the purchase account used for only for purchase of goods. Sales account is used when goods are sold. So purchase returns account is used when goods purchased returned. Sales returns account is used when goods sold or returned by the customers. So goods account is having 4 important accounts. Purchase account signifies goods purchased. Sales account signifies goods sold. So these important. So when goods purchased, purchase account is debited. When goods sold, sales account is created. When goods returned to Rani, because which are purchase returned, purchase return account is created. When goods returned by Hari, because sales returns account is debited. So purchase account is always debit, sales account always credit, purchase returns account always credit, sales returns account always debit. So common errors means purchase account is used only for goods, not for land. That's why it's wrong. And land purchase, land account is debited. When furniture sold, furniture account is created, not sales account. That you have to remember. When capital account, capital account and drawings account are alias names of owner. So when owner gives, a capital account is created. When owner takes away, a drawings account is debited. So because of business entity concept, when owner gives, cash is coming to business, cash account is debited. When owner takes away from the business, cash is going out, cash account is created. So in case of nominal accounts, don't use personal account. When personal account is given with the nominal account, personal accounts are to be equal. Salary paid means salary account to cash account. Prime account need not be used. This is wrong. When rent received from tenant, cash account to rent account. This is correct. So using our account is wrong. These are the very important journal entries to remember. If you have any doubts, you can share me with by a comment in the YouTube video. Okay. So I'm stopping the share. So these are the very important common mistakes usually done with the students, and students usually confuse with reference to the journal entries which we are discussed 12 journal entries. So if you see 1 or 2 times this video or lesson, no doubt you will get very good clarity and you feel blessed in writing journal entries. Thank you very much.